It's been a turbulent week for the Indian stock market, and today we're diving into the sharp 5-day decline that's hit the markets hard, with a special focus on the massive market cap loss for Reliance Industries. Let's unpack what's been going on, why it's happening, and what it means for investors and the Indian economy moving forward. Over the past 5 trading sessions, Indian equity markets have taken a serious hit. The BSE Sensex and NSE Nifty 50, our benchmark indices, each dropped by about 0.7% for the week. To give you a sense of the intensity, on May 22nd alone, the Sensex plummeted 869 points, a 1.06% dive, while the Nifty fell 1.09%, slipping below the 24,450 level. This sell-off wiped out significant market capitalization, with blue-chip stocks bearing the brunt. Reliance Industries Ltd, India's largest company by market value, was hit especially hard, losing over a 4,800 crore, roughly $5.5 billion in market cap in just 1 week. By the end of the week, the Nifty closed around 24,153 points, and the Sensex was near 81,721 points, reflecting a cautious, almost jittery mood among investors. So, what's driving this sharp decline? A big part of it comes from global headwinds creating a risk-off sentiment worldwide. Concerns over the United States debt burden and fiscal deficits have pushed U.S. Treasury yields to multi-year highs, with 10-year U.S. bond yields climbing to around 4.6%, the highest since 2023. This spike, coupled with Moody's downgrading the U.S. sovereign credit rating due to deficit worries, has soured investor appetite for emerging markets like India, leading to foreign portfolio outflows. Equity markets across the Asia-Pacific, like Japan's Nikkei, South Korea's Kospi, and China's CSI 300, mirrored Wall Street's sell-off, falling by about 0.51% during this period. Renewed trade tensions, with the US threatening hefty tariffs and stirring fears of a trade war, along with US-EU trade uncertainty and protectionist moves, have further dampened global sentiment, filtering through to Indian bourses. A soft patch in commodities, with Brent crude hovering in the low 60s per barrel due to demand concerns, and a US dollar index hitting multi-month lows, have added to the cautious stance. Emerging market currencies like the Indian rupee faced intermittent pressure from capital outflows, and signals of tighter monetary policies from Asian central banks have reinforced this risk-averse environment. On the domestic front, Indian investors are also turning cautious. With key local events and data releases like upcoming GDP figures and Reserve Bank of India policy signals on the horizon, market participants have been hesitant, choosing to book profits after prior rallies. The sell-off was broad-based, but sectors like information technology and financials, the heavyweights in our indices, led the decline due to mixed corporate earnings and global demand worries. On May 26, nearly every sectoral index, from auto to banking to oil and gas, posted losses of 1% or more, with only a few defensive sectors holding up. Stock-specific disappointments, like weaker than expected earnings, were harshly punished in this nervous environment. After a strong run in recent months, Indian equities were trading at relatively high valuations, making them ripe for a correction. The Nifty struggled to break above the 25,000 level left it vulnerable, and tighter liquidity from foreign investor withdrawals meant domestic institutions couldn't fully counter the selling pressure, tilting the market's short-term bias to the negative. Reliance Industries, the bellwether conglomerate spanning oil to telecom, was at the heart of this downturn. Its market capitalization dropped by about 40,800 crore in just 5 days, shrinking its valuation to roughly Rs 19.3 lakh crore by the week's end. For context, the next biggest loser, TCS, saw a loss of about 17 to 700 crore. As a heavyweight making up a double-digit percentage of the Sensex and Nifty, Reliance's slide dragged the indices lower. Its stock is down over 20% from its 2024 peak, even trading near 52-week lows. Global uncertainties like volatile oil prices and trade policy risks have weighed on its energy business outlook, given its role as an integrated oil and petrochemicals major. While Reliance's Q4 FY25 profit rose about 6%, segments like petrochemicals faced margin pressure from high input costs and fluctuating demand. Its telecom arm, Jio, and retail arm, despite growth, operate in highly competitive markets, and any hint of margin compression or heavy capex needs has made investors cautious. The stock breaking below key support levels around our 200 triggered technical selling, and persistent FII outflows hit Reliance hard as it's widely held by foreign funds. Recent company news, like our 75,000 crore investment pledge for projects in Northeast India and talk of potential IPOs for geo platforms or retail, promise long-term value but can spook investors in the short term due to fears of equity dilution or execution risk. That said, no negative corporate announcement from Reliance itself triggered this sell-off. It's largely a reflection of broader market nerves and technical selling pressure. This market drop has shaken investor sentiment, particularly among foreign investors. After modest buying earlier in May, foreign institutional investors flipped to heavy selling, pulling out roughly 11,591 crore from Indian equities in the latest week, triggered by global headwinds like US fiscal concerns. Domestic institutional investors, like mutual funds and insurers, remained net buyers, but couldn't fully offset the volatility. Despite these outflows, India hasn't lost its appeal entirely. Total FII flows for May 2025 were slightly net positive at about Rs 13,835 crore, thanks to robust buying earlier in the month. Long-term foreign investors remain optimistic about India's over 6% annual GDP growth and improving corporate earnings, with May's inflows on track to be the highest in 8 months before this pullback. On the foreign direct investment front, net FDI into India plummeted by 96% in FY 2024-25 to just $353 million from $10 billion the previous year, largely due to capital repatriation from high-profile IPOs and stake sales in companies like Hyundai Motor India, Swiggy, Airtel, and ITC. Indian companies investing more abroad also lowered the net inflow. However, gross FDI inflows remained robust at about $81 billion, showing continued foreign interest in sectors like manufacturing, financial services, energy, and telecom. This drop reflects market maturity, but sustaining investor confidence will require political and economic stability. Looking at the short-term outlook, volatility is likely to persist until global uncertainties ease. A resolution to US debt issues or cooling trade tensions could lift sentiment, but worsening global risks could keep markets under pressure. One fund manager noted that with US tariff uncertainty, Indian markets might remain a sell-on-rise market for a few months. Retail investors might turn defensive, and IPO activity could slow if bearish sentiment lingers. Prolonged FII outflows could pressure the rupee and India's forex reserves, possibly prompting RBI intervention. The wealth effect of a market decline could soften discretionary spending, though this would likely be minor unless the downturn deepens. The RBI and government are monitoring closely, and sustained weakness might push for reforms or stimulus, though inflation and fiscal deficit concerns limit their options. Over the long term, India's resilient growth story, with projected 6% plus GDP growth, acts as a backstop. As global factors stabilize, investors will refocus on India's robust earnings, large consumer base, and structural reforms. Corrections like this can make valuations attractive, drawing long-term capital. History shows foreign investors return after risk aversion fades, and with India's stable politics and fast-growing economy, FDI should continue flowing into infrastructure, manufacturing, and technology. FII flows could revive if global interest rates turn favorable, like with potential US Federal Reserve rate cuts. To mitigate global volatility, India may strengthen its forex buffers and encourage domestic market participation. This correction is clearing out market excesses, setting the stage for sustainable growth. If it leads to reforms like faster approvals or tax tweaks and companies improve efficiency, India's economy could emerge stronger. In summary, the past 5 days have been a wild ride for the Indian stock market, driven by global tremors and domestic caution. Reliance Industries' Rs 40,800 crore market cap loss shows even giants aren't immune. Investor sentiment has taken a hit, with FII outflows and a sharp drop in net FDI reflecting short-term jitters. But India's long-term outlook remains bright, underpinned by solid fundamentals and growth opportunities. This decline could be a temporary setback, and savvy investors and policymakers will be watching global developments, positioning for a rebound when the clouds clear.